Alright, so the initial plan is actually to spend some time here in my studio and talk to you about 4 ETF that you can begin investing with, especially if you are still a beginner who wants to actually start investing in stocks or ETF. But right now we have an issue here. There's some renovation going on upstairs, and I guess we have to come back later, alright, to record. And right now I think we shall just go out and grab a coffee, and then before we leave, we have to go up and ask by what time the renovation stuff will be done. Okay, so without wasting too much time, I guess I'll just spend some time, just use this as an excuse to grab some coffee. That's going to be a very draggy day. Right, coffee first. 8 gram， 为什么？因为星巴克。这是一个盘来的。Alright, so finally it is past 5 PM and there's no more distraction from the renovation upstairs, and I can finally sit down and talk to you guys and record this video peacefully. So in this video, I'm going to share with you 4 ETFs to actually begin investing with if you're looking into making your very first step into investing in the stock market. Now, the first thing that I need to explain is actually why are we even talking about ETF investing rather individual stock investment. Now, this is because when we buy into an ETF, we are actually buying into a basket of shares. So this is the easiest way to actually let your money to be exposed with varieties of stocks from different sectors. So in this case, we can get a diversified investment with very limited capital. When a company which is an index component becomes worse, it will be expelled from the index and being replaced with another company which is more fundamental sounding, which means indexes are actually created to go up in long run because the worst performers will actually being replaced very frequently with better performers, which means when you invest in great ETFs, the prices will actually go up in long run. Now, of course, the prices of the ETF can go up and down over the short term, but nonetheless, it will not crash to worthless even though if you do not have great risk management. This is perhaps the major reasons why great ETF like what I'm about to share with you in this video are actually great starting point for new investors. So if you are ready, let's move on. The fastest way to get exposure to the entire market from mega caps to micro cap is actually by investing into a passively managed ETF called VTI, which is the Vanguard Total Stock Market ETF. Now, this ETF invests in more than 4,000 companies, mainly in the United States. Now, when we look at the sector allocation, we can see that the technology comes at the top of 32%, and then we have consumer cyclicals, we have financial, healthcare, industrials, energy, and so on. The one thing that investors have concern about this ETF is the fact that it invests in more than 4,000 companies in this portfolio. Now, over-diversification generally reduces portfolio returns without actually meaningfully reducing the risk, and at some cases, it will also increase the overall transaction cost. However, looking at the expense ratio of VTI, it comes in at 0.03%, which is, I would say, class leading. If you do not know what is expense ratio, it is basically the total percentage of the fund's assets being used in administration costs, in the brokerage commissions, and also whatever costs that the funds have to use in order to run this ETF. So coming in at 0.03%, I would say that this is not actually an issue when it comes to the cost of managing this ETF. Now, when it comes to the performance, the annualized return over the past 10 years is actually about 16%, which is not too shabby. And in fact, I would say that this is a very good starting point for a lot of people. Now, by the way, if you do not know what website is this is basically ETF.com, whereby you can find a lot of information about different ETF in this website. And another website that I use very frequently is called etfdb.com. You can find information like the past performance, the necessary information that you need to know, the sector allocations, the top 10 holdings, and things along those lines. Apart from VTI, which invests into the entire market cap spectrum, you can also look into S&P 500 index ETFs. Now, S&P 500 index ETF tracks the movement of the S&P 500 index, which is being used as a benchmark of the market. Now, there are many ETFs for this. The popular one would be SPY, VOO, and actually IVV. Basically, they are the same thing issued by different issuers. Now, for demonstration, I'll be using the SPY, which is the SPDR S&P 500 ETF Trust, which is the one with the highest AUM, the highest liquidity, as well as superb liquidity and open interest when it comes to its options. Now, the expense ratio for SPY is actually higher than VOO and IVV. So SPY expense ratio comes in at 0.09%, whereas VOO and IVV expense ratio comes in at only 0.03%. However, as I buy and sell options quite often, SPY is definitely the go-to, at least for me, just for this reason alone. Now, but not in this video, more on that maybe in another upcoming future video if you guys are interested in it. So back to the S&P 500 Index ETF. The S&P 500 Index ETF basically holds the 500 companies which are the index component of the S&P 500. Right over here, we see that the number of holdings is actually 507. The reason is because some of the stocks like Alphabet, which is Google, they have different classes of shares, one with voting rights and another one without. 500 companies is not overly diversified like VTI, but it is still very diversified. Now, when it comes to sector allocation, we can see right over here, it is pretty much just like VTI. We have technology staying at the top, followed by consumer cyclicals, we have financials, healthcare, industrials, and so on. One thing to take note about S&P 500 Index ETF is that it is a little bit more top-heavy compared to VTI. So top-heavy means that the highest weighted company represents a large portion of the entire allocation. So movement of these top holdings would sort of like influence the price of the ETF a lot. So right over here, we can see that the top 10 holdings weighed in at around 29.69%, whereas for VTI, the top holdings weighed in at about 24.85%. So again, SPY is a tad more top-heavy compared to VTI. Again, to me, that is not really an issue. So on the performance side, we can look at the S&P 500 Index ETF. For the past 10 years, it comes in at around 16.47% annualized return. Now remember, S&P 500 is one of the most popular indexes out there, and it is also the benchmark of the market. It is designed to go up in long run, and the committee will always put the best company into the S&P 500 index, just like the Tesla inclusion during December 2020. And of course, after that, the ETF will also follow and include Tesla into their portfolio. Now, S&P actually dates back in the 1920s, becoming a composite index tracking 90 companies back in 1926. The average annualized return since its inception in 1926 through 2021 is actually 10.49%. The average annualized return since adopting 500 stocks in the index in 1957 through 2021 is 10.67%. And this figure is the average annualized return for almost a century, going through all the market booms, recessions, and crises that you have ever heard. So if proven track record is what you are looking for, S&P 500 Index ETF is what you should be looking into. VTV invests in mega cap to mid caps in the US market. The total number of holdings is about 340 companies, less than the S&P 500 index and significantly less than VTI. Now, when we look into the exposure of this ETF, we can actually see that the direction of this ETF is very different from other ETFs mentioned just now. Arguably, this ETF has higher exposure to sectors that are more defensive, but actually I don't call them defensive, I call them traditional sectors. Now, it has higher allocation in the financial sector, coming in at 26.9%, followed by healthcare, industrial, consumer, and then only technology comes in at 8.14%. This is a great ETF if you want to mix in a different flavor into your ETF investment portfolio. Now, it is not top heavy as well. The top 10 holdings weigh in at only about 20%. Now, we have familiar names like Berkshire Hathaway, JP Morgan, United Health, Johnson & Johnson, P&G, Bank of America, Pfizer, ExxonMobil, and so on. Performance-wise, it is about 13% per annum annualized return for the past 10 years again, which is not too bad as well. Now, last but not least is my absolute favorite ETF, which is the QQQ, INVESCO QQQ Trust. Now, the underlying for QQQ is actually Nasdaq 100, which is not Nasdaq, but the top 100 companies by market cap in the Nasdaq. This ETF is a little bit more aggressive compared to the other three ETFs mentioned just now, but it is still a very safe investment to begin with compared to buying and investing into individual companies without prior knowledge and experience, because after all, you still get the top 100 companies listed in the Nasdaq exchange. It is also the least diversified ETF compared to the ETFs that we mentioned just now, but again, 100 companies, it is still a very good diversification. But there is something that we need to talk about when it comes to this ETF. Now, this ETF is very top heavy. The top 10 holdings weigh in at 52.73%, which is more than half of the allocation. Now, Apple comes in at 11.63%, Microsoft right now comes in at 10.11%, which means if the stock price of these two giant companies were to drop, then the price of the ETF is probably going to go down as well. For sector allocation, the technology sector weighs in at 63.53%. Now, from a diversification standpoint, this may not be the best. However, for me, I kind of love this ETF a lot. Now, let me explain. If we look into the top holdings company like Apple, Microsoft, Amazon, Facebook, they are actually involving in the next big trend like metaverse, and companies like NVIDIA, they're actually going to be one of the most significant semiconductor players in the market, be it we talk about clean energy or metaverse and anything related to technology which requires semiconductor. And if we look at Tesla, it is always the role model of clean energy or technology. So come and think of it, for the upcoming years or even decades, no matter what the trends and which direction the world is actually heading, now we are going to need technology very much, and technology will still be the leading sector of the entire world. And investing in ETF like QQQ, your money will always go into the best companies out there. So of course, not 100% of your money is going into the technology sector, but it is close. It is like more than 60% are exposed to the technology sector. Performance-wise, QQQ averaged at around 23% annualized gain for the past 10 years, which is the best performing ETF in this list. And no doubt, the technology sector has been governing the world for the past decade. And if you think that the technology sector will still continue to shine, it will still be the most important sector for the next decade or the next decades, QQQ is the ETF that you should be looking into. So, question of the day. Which ETF do you like the most and why? Share with us in the comments below. And that will be all for this video. I hope that you learned something from this video. You love the sharing. If you do, please hit the like button. That would be very grateful. It helps the algorithm. And also, if you want to watch my upcoming videos, don't forget to hit the subscribe button and turn on the notification bell. And I will see you when I see you. Peace.